Thanks for clicking. We had an interesting week in China's real estate crisis this week as we found out that Chinese banks are now valued at the same level as U.S. banks were during the 2008 financial crisis.
You're welcome.
However, we did receive some news that might be of assistance to the banks as Beijing announced it would be expanding its support for the property market by increasing its bond financing program, providing much-needed financial support for Chinese real estate developers. And finally, we received some more news this week that China's property downturn, Beijing's shift away from a focus on its economy, is causing many of China's wealthy to head for the exits, looking to get their money out of the Communist Party state. So what I want to do today is look at the recent devaluations of China's top banks, take a look at some steps being taken by Beijing to prop up the real estate market, and then discuss the growing amount of wealthy Chinese trying to get their money out of China. Wealthy Chinese leaving the country means that their money has to go somewhere, which could very well end up in Canada's real estate market, despite the foreign buyers ban. We'll continue to track China's real estate crisis on this channel every Friday. Click like and subscribe if you want to get those updates, but for now, let's get into these banks. As mentioned, as a result of the continuing property crisis, the mortgage boycotts, and continual defaults on the part of real estate developers, China's banks are now valued at the same level as U.S. banks were during the 2008 financial crisis. The concern on the part of investors is that bad debts could pile up at these Chinese banks, with property developers continuing to default and Chinese homeowners failing to make their mortgage payments.
If fool me, we can't get fooled again.
Indeed, it was reported this week that 4 of China's top lenders have valuations 40% of their book value, the difference between their assets and liabilities. So, as per their stock price, the lenders are worth 40% of the sum total of their parts, to very much the same extent as were Bank of America and JP Morgan during the financial crisis in 2008. Granted, the cause of these banks' problems is very different than the causes of the 2008 financial crisis, which is obviously a different video for a different time. But we're definitely seeing a continual deterioration of investor sentiment for the Chinese property market and its economy, with investor support continuing to sour with funding drying up. Beijing is stepping up and coming to the table with even more funding for the property market, providing 250 billion won, about $35 billion, in bond support. And by bond support, Beijing means it's going to be providing loan guarantees, like co-signing for a loan, credit enhancements, and bond purchases, outright providing loans to these real estate developers.
I'll be back every Saturday, partner.
The move comes after calls from the PBoC, the People's Bank of China, for Beijing to increase support to property developers after China's sales slumped in October and real estate defaults continued to rise. In the state, Beijing is basically the only creditor left that will lend these developers money, as all sources of domestic and international credit have all but dried up. This has been going on a year now. Would you lend these developers any money?
Actually, that all depends.
While Beijing is a guarantor, a lender of last resort for these real estate developers, it's very much a mutually beneficial relationship. More defaults, more incomplete projects would no doubt lead to a further deterioration of public confidence in China's real estate market. Confidence which Fitch International Ratings Agency says China must restore or it could face systemic risks to its banks going forward. Fitch noted failure to restore homebuyer confidence resulting in prolonged property market stress beyond 2023 could test the banking system's resilience. So while Beijing has let this crisis spread for the past year, Fitch is warning that if it doesn't prop up the market, if it doesn't restore homebuyer confidence, it could see this crisis spread to the banks, which is definitely something Beijing wants to avoid. But it's not clear that $35 billion will be enough to do the trick. As we've noted before on this channel, estimates vary, but China's real estate market might need upwards of $501 billion to fix this crisis.
I need a check, preferably today.
But it's not just the banks, the investors, and homeowners which have had their confidence shaken on the Chinese economy, as we've received news that a number of wealthy Chinese are looking to get themselves and their money out of the country. According to the South China Morning Post, with Xi Jinping focused on common prosperity, many of China's elite are looking to emigrate over the next few years, even amidst global inflation. And I think that's a good point on the part of the Post. If China's wealthy are looking to leave, if they're looking to get their money out of China into an environment where their money sitting in cash is likely to diminish over the next couple of years with inflation, with global inflation running at 6, 8, 10%, That really says something about their worries about China's economy in and of itself. If they think their money is safer abroad when we're entering into a recession, when our inflation rate is so high, that definitely is not a positive outlook for China. The renewed interest in immigration from China on the part of wealthy Chinese comes as newly appointed President Xi Jinping promises to focus more on common prosperity and more equal wealth distribution, a potential major break from China's economic focus over the past 40 years. So yeah, China's wealthy are looking to emigrate, looking to move themselves and their money out of the Communist Party state amid a worsening economy, continual zero COVID measures, a worsening real estate crisis, and more redistributed policies coming from the head of the state, coming from President Xi Jinping. So this week we have Chinese banks valued at the same level as US banks in 2008. Not a great time for US banks. We also have the state, Beijing, stepping in to try to further re-prop up the property market with $35 billion in new funding, which probably is just a drop in the bucket and won't be enough. And we see more and more wealthy Chinese trying to get their money out of China, which, as we talked about from the very beginning, was one of the biggest worries when this crisis started, that the wealthy, that the money would try to leave China and end up in the West, end up in Canada, in our real estate market. And we've talked about all sorts of loopholes on this channel before on how that money can end up in our market, which would re-prop up our own prices. Whether or not China can get its economy back on track and assuage the fears of investors remains to be seen, but we'll obviously continue to track its progress on this channel every Friday. Click like and subscribe if you want to get those updates, but for now, thanks so much for watching.